Hi, this is Randy Finney with Right Side of the Chart, and today is Monday, May 2nd, 2016. Over the last week or so, I've been making the case, and my expectation is for what I'm referring to as a broad sell-off. In contrast with the trading throughout most of 2016, which has seen a lot of sector rotation. I think the charts look like the markets are due for a pretty broad-based sell-off. And in this video, I'll just quickly go through some of the sector ETFs to make my case. The nice thing about this is that the train hasn't left the station yet. I get a lot of emails and contacts, people reaching out to me, especially those that don't have the luxury or desire to trade full time, and they just want to know, um, when those really ideal risk reward opportunities are to position either long or short for a turn in the market. They're not really active traders and they like to just position for, a few weeks or more. And I think that time is here. And again, I like to, do these videos in my own trading style. I like to get in front of moves, whereas other traders wait for confirmations. And, the problem with that, especially in a whippy market, is if you wait for trend indicators to confirm a bearish trend before going short or vice versa on a bullish trend, uh, more often than not, the trend is almost over at that point. Again, if it's going to be just a short correction or multi-week pullback, and that's what right now that's all I'm eyeing. But I think it has the potential to morph into more. So as I stated, my preference is to short sector ETFs, especially the leveraged three-time long sector ETFs. That way, if it takes a little while, let's just say my call for a pullback materializes, but it takes a while to really start playing out, and the markets just sort of trade sideways for a couple months or a few weeks before going lower, then that puts the decay in my favor. I also, right now, favor both personally and the trade ideas on the site sector ETFs because we are still in earnings season, and as most of you know, if you're caught on the wrong side of an earnings induced gap on an individual stock, that can cause you a lot of pain. It'll bypass your stops. Stops are not triggered at the stop price on a gap. You're really there's no way to limit your risk against a stock gapping with a stock gapping against you other than hedging up with puts on that or options on that particular stock that you're trading. So, all right, let's go into the charts and I'll make my case, and you guys can decide from there if how you want to position, if you want to do anything on this. Starting out here is XOP, the Spiders S&P Oil and Gas Exploration and Production ETF. This is one of my favorites. I'm short, what is it, Gush? Short Gush, which is a three-time long EMP ETF. And it's just one of many. I'm going to go through just a couple here that are not within the S&P 500, and then I'll go over my S&P 500 sector holding list right here. These are the sectors that comprise the S&P 500, and like I said, I'll try to make the case that I can pretty much see a pullback in just about everything across the board in the coming weeks here. So XOP, what we're looking at longer term, and I've been bullish for a while in the energy sector. Longer term, I remain bullish. You can see the divergent low there. Really, I haven't updated this particular chart in quite a while, but this was the bottom right here in the energy stocks. This was an important trend line which was taken out, and longer term that's bullish. However, we've had quite the run to get there. You can see that we had a little consolidation before the breakout and a strong move. So really off the bottom, we're already about 64%. And that's just year to date. That's just from, in the last couple months, 64%. That's a sector, not a stock. Overbought would be an understatement. You can see down here the RSI has been pressing up above the overbought 70 level for quite a while. So overbought in itself isn't a sell signal, but it is a warning that prices are getting a little ahead of themselves, a little too much too fast. And so here we have an uptrend line which you can watch. My guess is this: when this market rolls over, I'm going to go over these patterns. A lot of these similar uptrend lines and rising wedges. Prices are still in there, but I think once they break, it's going to be a quick move down. So I'd rather be positioned ahead of time, which I am, versus trying to wait for confirmation. Which really, if you don't get in quick, especially if you work a full-time job and you're not watching the markets, by the time you come home, read that the Dow was down 300 points for the day, or it's 2 days in a row. you're going to have missed an objective entry. So that's what I'm seeing on XOP. And this is the only one. I'll just go through a few of the top components. The rest I'll just hit on the sector ETF. So let's make the case for an oil and gas short. These are the components, and a lot of these overlap with XLE, which I'll touch on because XLE is the broader, that's the energy sector or energy industry really, and then you have these subsectors within. XLE is in the S&P 500, or at least the energy sector. I have that one in there. So this is, again, you're going to have a lot of overlap here. Keep that in mind if shorting. For example, if you're short both, what is it, ERY, which is the 3-time long energy sector ETF, equivalent to XLE, and you're also short Gush, then you're going to have a lot of overlap. Both of those have the big dog here. Here's a related item. I call ExxonMobil the big dog. That's the biggest stock in the energy sector, one of the world's largest companies. So we'll start there, and I'll just go through because these are the top weighted. You can see ExxonMobil's a $365 billion company. Chevron's behind it at just under $200 billion. And then we'll just go down the line. So if you know where the leaders of the sector are going, that gives you a good idea where the whole sector is going. So here's ExxonMobil. This was a horizontal resistance level I had for a while. We took out that recent reaction high right here, which in itself was bullish. However, ExxonMobil is quite stretched. There's also this reaction high back from, looks like about a year ago, May 5th, 2015. And that's where ExxonMobil is struggling now. So you can see here, here's another stock, overbought, at resistance, divergences in place. The divergences, I don't have them drawn out yet. You can just make it out here. You see the MACD making a lower high. You can see it starting to roll over. Once it rolls over, that'll be confirmed. And I'm referring to that reaction high from back at early November 2015. So there's your divergence. Price is making a higher high against the MACD, the RSI, and imagine most other indicators, oscillators, also making lower highs, negative divergence at resistance. Enough said there. You can even have, if you zoomed in on the intraday charts, if you really want to hone down your exits and not jump the gun, put an uptrend line, this minor uptrend line right here. I'm sure that'll show through on the 30 or 60-minute charts better. Break of that would probably be the catalyst for the sell-off. Then you have this other alternative trend line. I only have a couple reactions there. I'm actually more partial to that trend line right there, to be honest with you. So I'm already short the sector. Doesn't matter to me. I'll add a little bit if and when I get this confirmation. Here's Chevron Texaco number 2. Same thing. Rising wedge pattern, divergent high. I could extend these lines, the divergences all the way back to this point, just like on ExxonMobil, that November reaction high, if I wanted to. But I also have this smaller rising wedge pattern drawn, which is equally as valid. You can see the negative divergence highlighted here. We've already turned down, and we're in really right now a pending crossover on any more downside or even sideways action in Chevron Texaco. There's a divergence there. We have some support. This was a recent breakout, and what I like these setups, right now, I use a term sometimes, and I refer to it as the charts being stacked. In other words, one event will trigger another. If we do have a breakdown of these bearish rising wedge patterns, this circled area was a breakout. A lot of bulls were watching that level. Undoubtedly, there's a reaction high. There were a pretty decent support level back here with numerous reaction lows. We took that out. So that's a breakout. Bullish on face value. However, if my analysis is correct and we break down from the rising wedge, we're also going to break back below this breakout point right here where we took out this resistance zone, these two close lines. So this is now a support zone. A break below would be quite bearish. And if you're looking at targets right now, I don't have any firm targets. I'd say at least a pullback to this area, 92.07. And again, I'm just making the case that the sector, these individual components confirm my bearish stance on the sector. Here's ConocoPhillips, COP. You can see prices rolling off that nice downtrend line pretty well, very well-defined downtrend line. Prices rolling off there. Here's an uptrend line to watch. Recently broke above this support zone, resistance zone, which is now support. So again, we have what I like to see, intersecting support levels. And if they're all taken out, the uptrend line and the bottom of that support zone, that'll be quite bearish. And my expectation would be a move somewhere down here. To quantify that, you're looking at about a, 18, almost 19% drop. Okay, a couple more and we'll leave it alone. There's symbol OXY, and we're at resistance. We had a breakout recently. Again, like I say, on face value bullish. And if you're a more conventional trader, you want evidence, you want to see that breakout fail. Nothing wrong with that. You can wait. Um, but here's a near-term uptrend line. So, if we fail here at this resistance level, come back in. At the very least, we'll probably backtest that breakout, but I think we'd go a little bit lower. And again, it would probably most of these stocks trade in tandem with the overall sector. So I think I've covered enough here. I don't see a lot on PSX. Now let's just drill through some individual sectors and we'll move forward. All right, another one that's not inside of the S&P 500, although some of the companies may be, GDX. I did an extensive video on gold and the miners today, so I won't spend too much time here. You can see this very steep rising wedge defined by this uptrend line and this uptrend line here, and negative divergence in place. That's the first time we've seen negative divergence on the daily time frame in GDX in quite a while. Tried to take some pot shots at 60-minute divergences and things that didn't play out for as much of a pullback as one would expect. But either way, GDX and the miners look poised to move down as well. And again, what I'm doing is making the case here. There's very few places I see to hide this time around, unlike in recent months, whether you were long or short, there were always something, money moving into, rotating out of one sector into another at any given point in time in the last pretty much throughout the year. The only other one there is XBI. Let's look at XBI. Now I'll cover XLV, which I have in my S&P 500 holdings. XLV is a healthcare sector ETF, so really a lot of these companies are also in there. Keep that in mind too if trading short the healthcare sector and the biotechs, that you will have overlap. And as such, you need to adjust your portfolio size so you don't have too much exposure to any one sector. I've made the case for quite a while. This shows through on the weekly charts on all of the three main biotech ETFs that I follow: IBB, XBI, and what's the other one? PBE. They all have these weekly bear flag patterns, and I've been short this one for weeks. I posted shorting that in the trading room back here. Last I looked, I think that position's already up by over 12, 13, or 14% or something like that as of today or earlier today, maybe a little more now. Again, I shorted the LABU, which is a biotech 3-time ETF, which worked well because since I made the short, for a while there I was about flat break even on the trade, but all this sideways action has actually benefited being short the 3-time leverage ETF because I reaped both the decay as well as finally this downside move, which you can see we're starting to move down impulsively now from that flagging type pattern. So a little support below, but again, this is one of the ones that I'm longer term bearish on. And let's roll into the sectors now. I'll put this up here and we'll go over these real quick. Here's XLY, consumer discretionary ETF. And you can see a couple things. I put this here. This isn't really a clean head and shoulders pattern, and I probably wouldn't even consider it as such, but I did want to point out there is the possibility, if we put a little circle here, that would be your left shoulder. This could be a head, and this could be a possible right shoulder. You can see the pattern there, and with this being the neckline. So the problem is this is a funky left shoulder. Something to monitor regardless, because we do have the what appears so far. And you see the volume surge right here on the formation coming off the head. That's one thing you want to see on a head and shoulders pattern, as well as if we do turn down here, what I've put is this near-term uptrend line that I'd be watching for a break. You have negative divergence, see down here on the MACD and RSI. You have the prices making a higher high against the RSI and MACD making a lower high. And there's that trend line, which would trigger a sell signal. And that gives us, again, only potential. If things got really ugly, move down there. Maybe it takes a while and give this pattern a little more symmetry, although I don't see that. That would take some sideways downwards action and then a move down. Either way, something to monitor. That's the XLY. Not one of my favorites, but just trying to, again, make the case. I'm trying to do a broad-based coverage here and make the point that just about every sector that I'm watching now looks poised for a correction. XLF, the financial ETF, you overbought, almost divergence. We have a bearish rising wedge pattern. It's not confirmed because both the MACD and the RSI made higher highs. Either way, I mentioned this gap is a very significant level. There's the New Year's gap I talk about a lot. So far, you can see XLF, the financials punched up into that gap, almost made a backfill and a turn down. So far, they've failed at that gap. This would be a significant technical event, a breakdown of this bear flag pattern. The bearish rising wedge pattern, if and when we break below that. And it appears to me that we probably will. So this is XLP, Consumer Staples ETF. And you can see we have this uptrend line. Let me get this out of the way here for a second. Uptrend line breakdown and what appears to be a bear flag pattern forming right now. So watch for a breakout of that bear flag pattern. This blue line goes back a few years. This is a 2-day, 4-year. Now we go back to a 3-day, a little longer term. So you can see this is a trend line going all the way back to 2011. In August 2011, very well defined, numerous reactions along the way, an impulsive breakdown, validating that trend line, back test, and I could see prices rolling over here following that most recent back test. So that's XLP. Go back to a daily chart. See if there's anything on the weekly chart to note. Well, this is the entire bull market uptrend line from the 2009 lows. Same story. That one I just showed back to 2011 actually extends back and just clips the bottom, just below the bottom of the 2009 lows. And like I said, we broke down. We've been back testing, moving up in this parallel sub-channel, if you will. So a break of that would most likely trigger the next major wave down. You can see the divergence here, negative divergence on the weekly chart. That's XLP, Consumer Staples ETF. Utilities, I mentioned this double top high recently. We had a very violent reaction or failure off that second attempt, or that attempt, I should say, to take out that previous reaction high. Prices have pushed back up after hitting a very solid support level and really giving up a lot of the gains already. Now, this whole cluster of candlesticks here should act as support. We're just getting up in there, but there's a lot of overhead supply to clear all the way up to that 49.25 area. Again, not one of my favorites, and it is a defensive issue. MACD is holding up on that zero line, so this is not a sector that I would consider shorting at this time. Just wanted to do a thorough analysis. XLI, this is the industrials ETF. Again, another subsector of the S&P 500. And you can see this very steep, look at that extended run. I mean, what a move from the January lows all the way up there. It's about 22%. And a very steep, pretty well-defined uptrend line, divergent high. You can see the divergence shown here on the RSI and MACD down below. We just recently looked like we cracked under there. And if the broad market rolls over, this one's most certainly headed lower. Eyeballing target somewhere around there, maybe $54 area. Again, not one of my favorites, but something worth mentioning. XLT, Telecom ETF. There's a very nice horizontal resistance level defined by numerous reaction highs back here, reaction lows at this point. We broke that support level, back tested. So it's a pretty well defined resistance level, and you can see we're just a penny or so, well, not a penny, but a couple, maybe 1% or 2% shy of that level now. And this is the pattern that I'm watching here. So more recently, we broke above this yellow downtrend line. That was healthy. Back tested, moved higher. But now you have this uptrend line, this near-term uptrend line to watch, sort of this ascending price channel. So you want to watch for a break below that level, and maybe that triggers a back test of this yellow downtrend line down here, somewhere at lower levels. If it took a while to get there, possibly we fall all the way back to this 54.20-ish area. XLK. Technology ETF, you can see tech is really rolling over after this divergent high right here, defined by this line from these previous reaction highs. And you know, the move down so far has been pretty impulsive. We traded in that little range for a while, broke below it, had this uptrend line, and I would say we've got a little more downside to go. And if things get really ugly, I think the tech sector is pretty overinflated right now. Meaning there's quite a bit of room to come out on the downside. So I could see another move down to this area over time, which is around 38 or so. XLB, this is one of my favorites. I'm short the basic materials as well. It's very steep rising wedge, a heck of a move. And, as most of you know, I've been very bullish and long a lot of the basic material stocks over the last few months. And now it's time to, I think, go the other way. We milked a lot of that run. Longer term, I'm bullish on this sector, but a 32% move in just what is that? Less than 5 months. A little too much, a little too fast, in my opinion, especially confirmed with the negative divergences you see down here. Clean rising wedge pattern, like a lot of those other ones I talked about. We had a breakout recently. This whole area here, this orange line, you can see very well defined the reactions, reactions, reactions. So that was a key level. We took it out, and again, my theory here is that we may very well see a bull trap, a failed breakout, which you see traders position scramble to correct their positioning. Those that went long to chase that breakout once they realized the breakout failed. Oops, wrong tool. Failed breakout, you usually see a very swift move in the other direction. So watch that level, that orange line. And if the breakout fails, I'd say we head at least down to that 44-ish area and quite possibly a little lower. And again, that might, at the time, if the charts confirm, maybe give us an objective re-entry on the long side there. Some basic material stocks or maybe even the ETF. XLV Healthcare, as I mentioned, I already went over the biotechs, a lot of overlap in this. Charts are pretty clear. There's a nice uptrend line to look at. We're flirting with that uptrend line now. So sort of an ascending channel, almost a contracting channel or wedge type pattern, if you will. And let's just see if there's anything on the weekly charts. Yeah, there's a breakdown, flag type pattern, another move from there, another flag. And PPO remains in bearish territory, sell signal as far as a longer term trend. This is a weekly chart. So I think the healthcare stocks are headed lower in the coming weeks as well. And finally, XLE. I started out with XOP. This is XLE, the S&P Spiders Select Energy Sector ETF. So this has those same names in there, the Chevrons, Exxons of the world. And you can see overall there's a breakout bullish, and I've been quite bullish and quite long the energy sector in the last few months, but I think it's time to step aside, be cautious, and maybe even trade a pullback. That's all I'm looking for here. So this one has some work to do. There's an uptrend line that I've added. But again, based on my analysis, like I just did on a lot of the top names in XOP, I think the case can be made, even if it's not as strong on this chart, for a pullback in the energy sector. Okay, this has been Randy Finney with the right side of the chart. I hope you enjoyed it.